Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, so I have Mr. Jim Welsh from Macro Tides. He's here joining us as he does every Friday. Hey Jim, how are you? Happy end of summer.
And happy end of week and ready for a 3-day weekend.
Yes. Definitely ready for a 3-day weekend, at least here in the United States. And we've seen a lot of, it's like the end of month, end of the summer, a lot of volatility. Stocks were just at all-time highs or nearing all-time highs. They're coming
Very
off a
close.
little bit. It's been real choppy. How are you reading this market right now and all the data that we've gotten this week? Anything standing out to you?
Not really. I mean, last week when we talked, the message was markets are at a crossroads. Well, I don't think anything got decided this week, really. And so I think for most markets, they're still on the cusp of inflection points. And this week, it just seems like suspended animation in a lot of the markets. Again, greater dependence on data, GDP was increased for the second quarter to 3%. And notably, like the amount of the revision wasn't all that big, but the composition change was. In other words, most other elements were downgraded, like inventories, business investment, and so forth. But consumption was ticked up almost 4/10. So the entire increase in the revision, what came from consumer spending. So to me, that aspect was somewhat noteworthy in it. And the other thing I talk about in my September macro tides is the bifurcation within the U.S. economy. And it's, extreme might be too extreme of a word, but it's very, very significant. You have the top 40% that are in great shape. Asset values have gone up significantly. They have savings that are generating 5% returns while it does nothing in effect. Whereas the bottom 40% are really under the gun. We're seeing increases in auto, credit card delinquencies, and so forth. So what's happening is those top 40% are going on trips and traveling and spending, which continues to help the economy move forward. At the same time, a lot of people, don't feel that good about their financial situation. So that bifurcation is endemic because of what's happened since the pandemic. But I think there's some deeper issues that I discussed in the September letter: the inequality of wealth, inequality of incomes. That's a problem, and we're seeing supposed political responses to that in terms of let's hike interest rates, or pardon me, taxes on individuals and corporations, and then the idea of even taxing asset values.
Yeah, but Jim, that's
That's
all
never been
talk.
done before.
It's all talk. No, I mean, what's really
Yeah,
going to change? I mean, for real.
nothing.
I mean,
Very little.
yeah. I mean, like we're going to continue to see this divide until when? Until when? I mean,
Well, I think if I'm right, and we're headed toward a secular bear market, just like the 66 to 1982 time period, where asset values didn't really appreciate very much. And given the dependence of consumer spending on asset values, you go through an extended period where stock prices go sideways to down, that's going to have a negative impact on the economy. We're running huge deficits. The outstanding debt continues to ramp higher, and somebody has to act like the adult in the room and address that. Well, the only way you address that is a combination of higher taxes, lower spending, if you want to be serious about it. Well, what's the impact on the economy going to be? It's not going to be a plus. So
right.
that
But
is some of the problems that we're facing, like, require tough solutions that neither party wants to advance.
yeah, well, that's the point, Jim. So the point is neither side is going to address these tougher solutions. So when does the market break? I mean, does it break?
Yeah. Well, again, I believe that the economy is going to continue to slow. It continues to kind of chug along. But from the bottom up, I think we're seeing erosion. And my take continues to be that we'll see the economy slow as we get into next year. I think a recession develops. I think commercial real estate is still a problem. We live in a very dangerous world. That's not going away. That, I think, is going to increase. So there's these factors out there. So when does it really hit the wall? I think when we start to see asset prices in terms of equity values respond to weaker economic growth. Now,
Yeah.
if the economy just chugs along at 2% and we never have another recession,
Well, that's the thing, is everybody's been calling a recession. You've told us literally for the last year that slowdown is coming, but you even look at the data this week.
Yeah.
It's fine. I mean,
Yeah.
where's the weakness, Jim? Tell me.
Well, part of it is if the government is running a 7% of GDP deficit, that has only happened either during war, like the 1940s, or during a deep recession. So we're seeing unprecedented government spending. In 7% of GDP, the economy is growing at around 2 to 2.5% if you look at the last 4 or 5 quarters. So that is one of the real tailwinds for the economy. And it's interesting, Blake, because Jay Powell has always just tried to avoid talking about the fiscal side. Well, that's not our job. But wait a second. When fiscal spending is making monetary policies work more difficult, I think, Jay, you should be talking about that. It is having an impact. And so, but your comment about how much will really change, not much. I mean, if anyone believes that suddenly, VP Harris is in favor of fracking, I mean, seriously? Oh, she's going to get tough on the border. I mean, so, and Trump has his own basket of lies. And that's the thing. We talked about this last week. What I find so discouraging is both sides are lying so much to their faithful in hopes that they'll get enough people independent, the middle of the road people, to buy into those lies and get them elected. This is not a good situation. I find it frightening, but enough already on that.
All right. Well, I know you discussed a little bit of politics last week. Let's go into let's go into your charts and just kind of talk about like the PCE that came up today. So talk about this PCE data that we saw.
All right. So if we think back the last 2-3 years, Wall Street has consistently been extraordinarily wrong about what the Fed was going to be doing. In early 22, well, they'll raise the funds rate 3 times. Wow, that was crazy. Coming into this year, well, they're going to be cutting 6 times. And so to me, what I wanted to talk about just briefly is to take our listeners, viewers, inside the FOMC meeting to have a better understanding of what the members of the FOMC have been debating and will debate, and how that will shape the decisions coming forward. So what this chart shows is the funds rate versus the core personal consumption expenditure index. So last July, when the Fed raised the funds rate to where it is today, at effectively 5.37%, the core PCE was at 4.8%. It's dropped to 3.1. So if you compare the funds rate, which has been flat, to the PCE, the real funds rate has gone up by 1.7%. So both doves and hawks on the FOMC, Blake, believe that this is a tightening and represents a tightening, which is why there's, I think, uniformity in terms of we're going to be cutting rates, because the drop in inflation has caused the real funds rate to go up, which represents a tightening of monetary policy that we really didn't intend. So this is one of the concepts that is going to be central to the debate. Now, the interesting thing, let's go to the next chart because I can't remember what I put in order. It's Friday. It's been a long week. Okay, good. So the neutral rate is a guesstimate of where monetary policy is either neither stimulative or restrictive. And right now, the guess is 2.5%. So There is no strict definition. Prior to the financial crisis, the neutral rate was up around 4.5%. So over time, it has come down. So again, what we can see is the spread between the neutral rate and where the funds rate is pretty high. Now, the doves think the neutral rate is closer to 2%, which then means the current funds rate level is even more restrictive. The hawks think it might be closer to 3%, which means less restrictive. But the point I would make is, irrespective of their different guesses, both groups can agree that at the current level, there is some level of restriction, which is why both the doves and even the hawks are ready to start cutting rates. It's like, okay, we've made enough progress on inflation. The economy's slowing down. The labor market is easing the tightness. So this is what they're talking about. And they will continue to have discussions about how tight monetary policy is or isn't. And it's all predicated on where each member believes the neutral rate is. And there's no, formula to specifically define it. And that's why there's wiggle room for both the doves and the hawks. But at this point in time, Blake, both groups agree that the funds rate is high relative to the neutral rate. Therefore, they need to bring it down. Obviously, you can see how low the funds rate was from 2020 and 2021, below the neutral rate. Talk about being stimulative. Right. And so now they're just going to reduce the level of quote unquote restrictiveness in coming months. The question then comes down to, well, how fast? Are they going to be cutting the funds rate? And are they going to be doing 50 basis point cuts instead of 25? And one of the components the Fed is going to be looking at is, I think the next chart, is bada bing, bada boom. Okay, so the Congressional Budget Office and the Federal Reserve have attempted to calculate is what is the, if you will, neutral rate for the economy. In other words, how fast can GDP grow without creating inflationary pressures? And both the CBO and the Fed are around 1.9%. So if GDP is growing above 1.9%, that is going to lend, if you will, toward inflation. Well, we just got a GDP report at 3%. And over the last year, GDP on average has been growing north of 2%. So my point being is, if I'm sitting on the Fed, the urgency to cut more than 25 basis points is going to be tempered by the fact that the economy doesn't need a whole lot of stimulation at this point in time. Yes, we need to lower the level of restrictiveness, but we don't maybe need to do it quickly. And so, for people to talk, well, they're going to be cutting 50 basis points at September. I don't think so, Blake. I mean, again, I think there's agreement to cut, but the strength of the economy at this stage of the game is going to make them think, you know what? We're going to be very measured about how we lower the funds rate, with the caveat, obviously, being, boy, if the unemployment rate really ticks up because of job losses, as opposed to what we've seen since March of this year, a bunch of people came into the labor force. So you saw the unemployment rate went up because the supply of workers entering the labor force increased. That's a whole different spin on the increase in the unemployment rate that we've seen over the last 6 months, as opposed to, wow, companies are really laying people off.
So in other words, you believe that even with a tick up in unemployment rate next week, which theoretically could happen, that doesn't mean that we're going to get a 50 basis point cut.
No, it doesn't, because we've talked about this. Jay Powell in his Jackson Hole speech referenced that what we've seen is, the labor tightness has eased and the unemployment rate's gone up. But a lot of that is because you had new entrants coming into the labor market. Now, some people think, well, those new entrants, a lot of them are, people who are in this country illegally. But nonetheless, from the Fed's perspective, is if you have an increase in labor supply, that's not inflationary. No, it does and has caused the unemployment rate to go up. Contrast that as opposed to companies laying people off. That would be way more worrisome. So my point is, the increase in the unemployment rate obviously has gotten the Fed's and Chair Powell's attention. But when they look under the surface, it's like, okay. And this is why I think, Blake, in July, the doves who were in favor, a few of them who were in favor of a cut, were willing to say, okay, we'll wait till September, because the pressing need that the unemployment rate appears to be giving us maybe isn't as legitimate. And I wrote about this in early August. As soon as the unemployment rate went up, like, folks, the Somme room triggered a recession signal. I said, nah. Now, my own personal take is, Blake, because we'll be talking next Friday, is I think the unemployment rate might tick down a tenth from 4.3 to 4.2. I think there's a reasonable chance that the job growth will jump a little bit from 114,000 to something a little bit bigger. So these numbers are always very volatile, especially the job numbers. But I just think that the table's set with Wall Street expecting, gee, the Fed could cut 50 basis points in September. And they're going to, well, the next chart goes into what Wall Street's expecting. And I think we may have talked about this last week. So Wall Street thinks the Fed's going to cut 100 basis points between now and the end of the year. There's only 3 meetings. So mathematically, the only way you get to 100 basis points is if the Fed cuts by 25 basis points at 2 of the meetings and 50 at a third. Given where we are right now, the data as it stands, the Fed, in my opinion, won't be cutting by 50 basis points. Certainly not in September, I don't believe. And I think the odds are not in the rest of the year. They're going to have to see the labor market weaken because of an increase in layoffs. No, maybe that's coming right around the corner, but it hasn't happened yet. Wall Street's looking for 100, basically 5 cuts almost next year. That seems a little bit aggressive to me. But again, it gets down to the pacing. A lot of people are saying, well, they're going to cut every meeting. If GDP continues to grow comfortably above that 1.9%, Blake, the Fed's not going to feel any urgency to cut more quickly. So the one thing also that came out of the minutes from the last meeting was many of the members wanted to emphasize how data dependent they were. We're at an inflection point, and they don't know what they're going to do. The data is going to kind of tell them what to do. And so to me, the idea of trying to guess, well, they're going to cut 3 times this year or 4 times, 100 basis points this year and 120 next year. And it's like, guess what, folks? It's unknowable, And so to me, the only thing I'm trying to do is trying to gauge what is most likely relative to Wall Street's expectations. So to the extent that Wall Street's expecting a 50 basis point cut in September, and if they don't get it, will there be some disappointment? I think so.
All right.
And the markets will respond accordingly.
Right. Okay. Well, let's see what you believe the market's response is going to be, as we go into some of the charts and some of these setups.
Yeah.
We've seen here, this is the 30-year. So what are we making out of this now that treasuries, well, this is yield starting to bounce back. Dollars coming back. You've been pretty bearish on the 30-year bonds. Or excuse me, bullish bonds, and bearish yields, but it looks like we're getting a reversal. So is this it?
Well, I pointed out last week, and is like really the last few weeks, as long as yields were below that blue line, below the channel that it's been in, well, you'd have to expect that yields are going to work their way lower. And at the same time, if yields go back, and the chart is the same on the 10-year, Blake, if you get back into that channel, I think there's a risk that yields will then go up to the upper channel line. Now, if I'm right and the job number comes in a little stronger, the unemployment rate actually ticks down by a tenth, to me, the chart is saying, I think this is becoming more likely. Confirmation will happen if and when it gets back into the channel. If it's going to happen, my guess, Blake, we'll see the yields go back into the channel before the employment report comes out. And longer term, I don't believe this changes the ultimate outcome of yields coming down fairly significantly. It just means the pattern is different and it will be delayed. So that from the high we saw last December, I think that we're seeing, we saw a decline in yields, a rebound, another decline. I'm talking about a modest increase in yields. I think ultimately bond yields are going lower. It's just that the pattern has changed, and confirmation of that change, I think, would be signaled if and when both the 10 and the 30-year get back into the channel. The thing I'll point out, one last point, the 10-year did get below the low of last December in yield. The 30-year didn't. And that's kind of been nagging at me because at numerous trend change points, you get this intermarket divergence where one market is doing one thing and the other aspect of the market is doing something different. And so, this is another reason that makes me think, okay, one has to be prepared. So from my perspective, being long TLT, if it gets back into the channel line, that should be your stop on TLT, which I believe is around 96.50-ish on TLT, plus or minus a little.
Got it. So, and I mean, you basically are saying the jobs report is going to come out better than expected next week, which we'll obviously meet right after it. With the better jobs report, yields are going to go higher, bonds are going to come down, and that should obviously impact equities. So the question will be here when you're talking about the S&P. Does the S&P rally on good data or does it sell off on good data? Because, if data is stronger, we get a good jobs report, and we're going to see a bunch of other data going into it, like the ISM, the ADP, the JOLTS, and
there's a lot of data in the first 10 days of every month.
Yeah, but you get all this, jobs data. Let's say it, just for argument's sake, it comes in better than expected. Does the market go down because we're not going to get 50 basis points, or does the market go up because they're cheering that we're going to have a soft landing and all the recession callers are wrong?
Yeah.
What's that?
Those are all, very valid points. I'm going to look at the pattern, and I believe that the low in early August was wave 4 of an advance that began off the lows from last April. And from that low in early August, you can kind of see 1, 2, very strong move up for 3. And now we've been just chopping sideways for, I think, about 7 trading days or so. And it's starting to look like a triangle pattern. That pattern is valid as long as the S&P holds above 55. The precise number is 5560.95.
Down here, right here.
Yeah, both those lows to the penny. All right. So as long as the S&P holds above those lows, I think the pattern says there's one more pop coming to the upside to complete the rally from the August low, and I think potentially as far back as April. And so my guess will be that pop will happen before the employment report comes out on next Friday. And that if the number comes in stronger, I think the initial response might be a knee-jerk, oh, great. Oh, wait, that means we're not going to, maybe we're not going to get the 100-point in rate cuts this year and so forth. And maybe that, I just think potentially, Blake, that the market won't like treasury yields popping and the Fed not probably going to be cutting as aggressively. Again, as I said before, I think the key going forward is where are expectations for rate cuts and what's likely to happen. I'm in the camp I think Wall Street's expecting too much.
Yeah, I was going to say I agree that Wall Street's expecting too much. It seems logical. Just as at the end of last year, everybody's expecting 6 rate cuts for 2024, and obviously they've been proved wrong. you know.
Right.
Yeah.
And in April, we're only going to get one cut. And some people were saying, well, maybe, after 3 months of bad inflation, the Fed might actually raise rates, which I thought was ridiculous. But, but that, again, my point is for those who are viewing us, it's like, folks, if you're going to take your guidance on monetary policy from Wall Street, that's not going to be very helpful, And so hopefully over time, you and I are talking about things that give people some more tools and better information so they can do some critical thinking and, just logically think about stuff. So anyway, to me, I think the S&P is going to have another pop, and then I think we're going to be ready for a correction.
Okay.
In terms
Well,
of, yeah.
let's talk about the dollar. You've been bearish the dollar, but in your scenario that you're working out with a better jobs report, the dollar has bottomed and the dollar should be rallying.
Well, when we talked last week, I said two important things. The dollar had undercut the low from last December at 100.62, which negated the idea of a triangle. And then looking at the pattern, it was like, okay, you can see from that high in April at 106.53, 1, 2, and we were in the middle of wave 3. And my point last week was, hey, we're nearing the end of wave 3, and we're about to get a bounce to the 102, 102.50 for what I think will be wave 4 before another decline takes the dollar down to a lower low. And you're right. I mean, when I start looking at charts, sometimes it kind of, for me, backs me into what data could come along that would suggest that stocks are near a short-term high, the dollar is going to get a bounce, and treasury yields are near a point where they could go into that channel. Well, a better jobs number would do all that, And so anyway, I think the dollar can have a little bit more upside to it for a wave 4, and then another decline that makes a lower low. And then potentially even another rally happens. In other words, you do a 4-5-4-5 type of mumbo jumbo, and that's where I think we're at. Sentiment is pretty negative, the dollar. Positioning is turned net short, and it's really oversold. So, and people, again, are overestimating rate cuts. So, last December, I was looking for the dollar rally. And when we talked, it was like 6, and you agreed, man. We both were on the same page. 6 rate cuts is delusional. Well, as that got peeled back, the expectation was we were going to see the dollar rally. And look at it, rallied from, less than 101 up to over 106. And, a 5% rally in what, 2-3 months? That's a pretty big move in any currency. And then my expectation was, hey, we're going to see more signs the economy slowing. People are going to start thinking about the Fed to cut, and we're going to see weakness. So again, gauging where Wall Street is on expectations obviously influences currency traders. And when they, get leaning too much to one side or the other, you got to fade it. And then when the chart, to me, supports it, that really helps a lot in terms of, for me at least, having a little bit more conviction of what's likely to happen.
All right. Well, the last chart is gold, and you want to talk about leaning. I mean, everybody's bullish gold. I don't think you're going to find a bear out there.
Yeah.
So what does that mean for the price of gold? I mean,
Well, I think we're nearing the end of the rally from last September. Gold bottomed at 1812. I think you can see, pretty clear. 1, 2, 3 up, chopping sideways, and then we're doing this grind higher. It's like, it just seems like if you could get a pop of 30 to 50 bucks one day, because there's got to be a lot of stops above 25, 40, something like that, and you can get a pop. And then I think that completes something on gold. And then it's going to be set for another, I think, decent size pullback. So again, if it's going to happen, I think it'll happen before the employment report. And I think if we get that pop, it's time to lighten up into that pop. And if the gold doesn't make this jump and closes below 2470, to me, that would start to severely challenge the idea that we are going to get that one more pop. But the chart just looks like it needs to get cleaned out by, boop, get the last shorts covered, get some more buyers in there, and then ready for a reversal.
All right. Well, we'll see if we can get that, Jim, because it has been a nonstop bull run in gold, and I know a lot of people are aching for some sort of pullback, and I know gold bulls are looking for 3,000. So it's going to be an interesting push pull between the two. So
well, and they're positioned for that, Blake. The thing is that when people start thinking 3,000, you start hearing that a number above a market getting bandied about. Well, what have people done with their money? They've already put it in. So to some extent, prices are reflecting that bullish bias, and which then to me makes them vulnerable if it doesn't come to pass. And then all of a sudden, the latecomers to the party wind up to be the early people to leave by selling.
Yeah. All right. Well, Jim, I want to thank you so much for spending your time with us. As always, next week is going to be a bazonkers week as everybody comes back in. And I know I'm looking forward to it. I know you're looking forward to it as well. So thank you for spending
rock and roll, baby.
Yeah. Thanks for spending your time with us. What's the best way for traders to follow your work?
Macrotides.com, or send me an email, jimwelshmacro@gmail.com.
All right, Jim. Thank you very much. And you guys, make sure if you do email Jim, let him know that you saw him here on Trader Summit. I appreciate you, Jim. Have a great weekend and a great long weekend. We'll see you next week.
You got it, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.